I've summed up my 10 takeaways and thoughts about this book in this video. I highly recommend you to read the original book of the author. Step-by-Step Bond Investing by Joseph Hogue is an informative and comprehensive guidebook that aims to help readers navigate the world of bond investing. Whether you're a beginner who's just starting out or a seasoned investor looking to fine-tune your strategies, this book offers valuable insights and practical advice on how to make the most out of your bond investments. The book is well organized and easy to follow, with each chapter building on the previous one to provide a step-by-step approach to bond investing. Hogue covers a wide range of topics, including the basics of bond investing, the different types of bonds available, how to evaluate bond quality and credit risk, and how to create a diversified bond portfolio that meets your financial goals. One of the things that sets this book apart is Hogue's clear and concise writing style. He avoids jargon and technical terms, making complex concepts easy to understand. The book is also packed with helpful charts, graphs, and real-life examples that illustrate key points and make it easy to apply the information to your own investments. In addition to the practical advice, Step-by-Step Bond Investing also delves into some of the more advanced strategies that can help investors maximize their returns while minimizing risk. For example, Hogue discusses how to use bond ladders to create a steady stream of income, how to incorporate bond ETFs and mutual funds into your portfolio, and how to take advantage of tax benefits when investing in municipal bonds. Another strength of the book is its focus on the long-term perspective of bond investing. Hogue emphasizes the importance of having a solid investment plan and sticking to it, rather than chasing short-term gains or reacting to market fluctuations. He also provides guidance on how to adjust your portfolio over time as your financial goals and risk tolerance change. Overall, Step-by-Step Bond Investing is a valuable resource for anyone looking to add bonds to their investment portfolio. Whether you're a beginner or a more experienced investor, this book provides the knowledge and tools you need to make informed decisions and build a successful bond portfolio. One of the main points of Step-by-Step Bond Investing by Joseph Hogue is that bonds can be a valuable addition to any investment portfolio. Unlike stocks, which represent ownership in a company and can experience significant fluctuations in value, bonds are a type of fixed-income investment that provide a steady stream of income in the form of regular interest payments. Bonds can be issued by a variety of entities, including governments, corporations, and municipalities, and each type of bond comes with its own risks and rewards. For example, government bonds are typically considered the safest type of bond because they are backed by the full faith and credit of the government. Corporate bonds, on the other hand, can offer higher yields, but also come with greater credit risk because they are issued by companies. By including bonds in your investment portfolio, you can help diversify your holdings and reduce overall risk. Because bonds are typically less volatile than stocks, they can help offset losses in a bear market and provide a reliable source of income even during times of economic uncertainty. Overall, Step-by-Step Bond Investing makes a compelling case for the role of bonds in a well-diversified investment portfolio. Whether you're a novice investor looking to get started with bonds or a seasoned pro seeking to fine-tune your strategy, this book offers valuable insights and practical advice on how to make the most out of your bond investments. Another key point of Step-by-Step Bond Investing by Joseph Hogue is that there are different types of bonds available for investors, and each type comes with its own set of risks and rewards. Government bonds are issued by national governments and are generally considered to be the safest type of bond. They typically offer lower yields than other types of bonds, but are backed by the full faith and credit of the government, making them a relatively low-risk investment. Corporate bonds, on the other hand, are issued by companies and carry a higher level of credit risk. This is because companies can default on their debt if they experience financial difficulties or go bankrupt. However, corporate bonds also typically offer higher yields than government bonds, making them an attractive option for investors seeking higher returns. Municipal bonds are issued by state and local governments and can provide tax benefits for investors in certain situations. For example, if you live in a high-tax state, investing in municipal bonds issued by your state or local government can help you reduce your overall tax burden. In addition to these types of bonds, there are also other specialized bonds available, such as inflation-protected bonds, which offer protection against inflation, and high-yield bonds, which offer higher yields, but come with greater credit risk. Overall, step-by-step bond investing emphasizes the importance of understanding the different types of bonds available and evaluating the risks and rewards of each before making an investment decision. By diversifying your bond portfolio across different types of bonds, you can help mitigate risk and achieve your investment goals. One of the key considerations when investing in bonds, as highlighted in Step-by-Step Bond Investing by Joseph Hogue, is the quality of the bond and the credit risk associated with it. Bond quality refers to the creditworthiness of the issuer and their ability to repay the debt. For example, a government bond issued by a country with a stable economy and a good credit rating is generally considered to be of high quality. Similarly, a corporate bond issued by a financially stable company with a good track record is likely to be of higher quality than one issued by a struggling company. Credit risk, on the other hand, refers to the likelihood that the issuer will default on their debt obligations. Bonds with higher credit risk offer higher yields to compensate investors for the additional risk. However, investing in high-risk bonds can also lead to greater potential for losses if the issuer defaults. To evaluate bond quality and credit risk, investors typically rely on credit ratings provided by independent credit rating agencies, such as Standard & Poor's or Moody's. These agencies assign ratings based on the issuer's creditworthiness and the likelihood of default. Overall, step-by-step bond investing emphasizes the importance of understanding bond quality and credit risk when making investment decisions. By carefully evaluating the creditworthiness of the issuer and the potential risks involved, investors can make informed choices that align with their investment goals and risk tolerance. As highlighted in Step-by-Step Bond Investing by Joseph Hogue, bond prices can be affected by a range of economic factors, including interest rates and inflation. When interest rates rise, the value of existing bonds decreases. This is because investors can earn a higher return by investing in newly issued bonds with higher interest rates, making existing bonds less attractive. Similarly, when interest rates fall, the value of existing bonds increases, as investors are willing to pay a premium for the higher yields offered by those bonds. Inflation can also impact bond prices. When inflation rises, the purchasing power of the interest payments and principal repayment decreases, making existing bonds less valuable. As a result, bond prices tend to fall during periods of high inflation. The relationship between bond prices and interest rates is often referred to as the interest rate risk. Bonds with longer maturities are typically more sensitive to interest rate changes than bonds with shorter maturities, as the longer time period until the bond matures increases the potential impact of interest rate changes. Overall, step-by-step bond investing highlights the importance of monitoring economic conditions and understanding the potential impact of interest rates and inflation on bond prices. By carefully evaluating these factors, investors can make informed decisions about when to buy or sell bonds to achieve their investment goals. One of the strategies discussed in Step-by-Step Bond Investing by Joseph Hogue is the use of bond ladders to create a steady stream of income. A bond ladder is a portfolio of bonds with staggered maturities. For example, an investor might purchase bonds with maturities of 1 year, 3 years, 5 years, and 10 years. As each bond matures, the investor reinvests the proceeds in a new bond with the longest maturity in the ladder. This approach ensures a steady stream of income and allows the investor to take advantage of changes in interest rates over time. By spreading investments across multiple bonds with different maturities, a bond ladder can help reduce the impact of interest rate changes on the overall portfolio. For example, if interest rates rise, the investor can reinvest the proceeds from the shorter-term bonds at higher rates, while still holding onto the longer-term bonds with higher yields. Bond ladders can also be customized to meet an investor's specific needs. For example, an investor might create a ladder with bonds that mature in the years leading up to retirement, providing a steady stream of income during those years. Alternatively, an investor might create a ladder with bonds that mature in the years following retirement, providing a source of income later in life. Overall, step-by-step bond investing highlights the benefits of bond ladders as a strategy for creating a reliable source of income and reducing the impact of interest rate changes on a bond portfolio. By carefully selecting bonds with different maturities and reinvesting the proceeds over time, investors can achieve their investment goals while managing risk. Step-by-Step Bond Investing by Joseph Hogue also discusses the use of bond exchange-traded funds, ETFs, and mutual funds as a way to invest in a diversified portfolio of bonds. Bond ETFs and mutual funds are investment vehicles that pool money from multiple investors and invest that money in a portfolio of bonds. This approach allows investors to achieve a diversified bond portfolio without having to purchase individual bonds themselves. Bond ETFs trade on stock exchanges, just like stocks, and can be bought and sold throughout the day at market prices. Mutual funds, on the other hand, are priced once a day after the close of trading and are bought and sold directly with the fund company. By investing in bond ETFs and mutual funds, investors can benefit from the expertise of professional portfolio managers who select bonds and manage the portfolio. Additionally, these investment vehicles can offer lower transaction costs and greater liquidity than purchasing individual bonds. However, investors should be aware that bond ETFs and mutual funds can still carry risks. Like any investment, the value of a bond ETF or mutual fund can fluctuate based on changes in interest rates, credit risk, and other economic factors. Additionally, investors in bond ETFs may be subject to trading costs and premiums for discounts to the net asset value of the fund. Overall, step-by-step bond investing emphasizes the benefits of bond ETFs and mutual funds as a way to achieve a diversified bond portfolio with lower transaction costs and greater liquidity. However, investors should carefully evaluate the risks and costs involved and ensure that the investment aligns with their investment goals and risk tolerance. Step-by-Step Bond Investing by Joseph Hogue also highlights the potential tax benefits of investing in municipal bonds. Municipal bonds, also known as munis, are issued by state and local governments to fund public projects such as schools, highways, and water treatment facilities. Because these bonds are used to fund public projects, they are typically exempt from federal income tax. Additionally, if an investor purchases a municipal bond issued by their state or local government, they may also be exempt from state and local income taxes. The tax benefits of municipal bonds can make them an attractive investment option for investors in certain situations. For example, investors in high tax brackets may benefit from the tax-exempt income provided by municipal bonds, as it can help reduce their overall tax burden. Additionally, investors who live in high-tax states may benefit from investing in municipal bonds issued by their state or local government, as the interest income may be exempt from both federal and state income taxes. However, it's important to note that not all municipal bonds are tax-exempt, and investors should carefully evaluate the creditworthiness of the issuer and the potential risks involved before investing. Additionally, the tax benefits of municipal bonds may not be as attractive in a low-tax environment or for investors in lower tax brackets. Overall, step-by-step bond investing emphasizes the potential tax benefits of investing in municipal bonds and encourages investors to carefully evaluate the risks and rewards before making an investment decision. By understanding the tax implications and credit risk associated with municipal bonds, investors can make informed choices that align with their investment goals and risk tolerance. Step-by-Step Bond Investing by Joseph Hogue also highlights the importance of creating a balanced and diversified bond portfolio. A well-diversified bond portfolio should include bonds with different maturities, credit ratings, and issuers. For example, an investor might include government bonds, corporate bonds, and municipal bonds with different maturities ranging from short-term to long-term. By diversifying across different types of bonds, an investor can reduce the overall risk of their bond portfolio. If one type of bond performs poorly, the other types may help offset the losses. Additionally, diversification can help provide a more consistent stream of income, as the different types of bonds may pay interest at different times. In creating a diversified bond portfolio, it's also important to consider the overall allocation of the portfolio. Bond investments should be balanced with other types of investments, such as stocks or real estate, to ensure a well-diversified overall portfolio. Additionally, it's important to periodically review and rebalance the bond portfolio to ensure it remains aligned with the investor's goals and risk tolerance. This may involve selling some bonds and purchasing others to maintain the desired level of diversification and risk. Overall, step-by-step bond investing emphasizes the importance of creating a well-diversified bond portfolio that aligns with the investor's investment goals and risk tolerance. By carefully selecting bonds with different characteristics and periodically rebalancing the portfolio, investors can achieve their desired level of risk and return. Step-by-Step Bond Investing by Joseph Hogue also stresses the importance of having a long-term investment plan and sticking to it, rather than reacting to short-term market fluctuations. Market fluctuations are a normal part of investing and can be especially pronounced in the bond market. However, it's important for investors to remember that these fluctuations are often temporary, and that a well-structured bond portfolio can help manage risk over the long term. One approach to managing risk is to use a bond ladder, as discussed earlier. A bond ladder can help provide a steady stream of income and reduce the impact of interest rate changes over time. Another approach is to use dollar-cost averaging, which involves investing a fixed amount of money at regular intervals, regardless of market conditions. This approach can help reduce the impact of short-term market fluctuations on the overall portfolio. Regardless of the approach used, it's important to have a long-term investment plan and stick to it, even during times of market volatility. By focusing on the long-term performance of the portfolio, investors can avoid making emotional decisions that may lead to missed opportunities or losses. Overall, step-by-step bond investing emphasizes the importance of having a disciplined investment plan that aligns with the investor's goals and risk tolerance. By focusing on the long-term performance of the portfolio and using strategies such as bond ladders and dollar-cost averaging, investors can manage risk and achieve their desired level of return. Step-by-Step Bond Investing by Joseph Hogue also emphasizes the importance of staying informed and up-to-date on market trends and economic conditions. Economic conditions can have a significant impact on the bond market, and investors who stay informed about these trends can make more informed investment decisions. For example, if interest rates are expected to rise, an investor may choose to invest in shorter-term bonds or adjust their bond ladder strategy to take advantage of the higher rates. Similarly, staying informed about credit rating changes and other news related to bond issuers can help investors evaluate the creditworthiness of their bond portfolio and make adjustments as needed. To stay informed, investors can read financial news sources, attend investment seminars or webinars, and consult with financial professionals. It's important to choose reliable sources of information and to avoid making investment decisions based on rumors or hearsay. In addition to staying informed, investors should periodically review their investment portfolio to ensure that it remains aligned with their goals and risk tolerance. This may involve selling some bonds and purchasing others to maintain the desired level of diversification and risk. Overall, step-by-step bond investing highlights the importance of staying informed about market trends and economic conditions, and of periodically reviewing and adjusting the investment portfolio as needed. By staying informed and taking a proactive approach to managing the bond portfolio, investors can achieve their desired level of risk and return. Thank you for your interest in this book. Please leave your feedback on these thoughts in the comments below, or just put a like on this video. It will help me stay motivated and make more videos like this. In the description of this video, you may find links where you can purchase this book.